All right, we are live. I want to make sure you guys can hear me okay. The levels are okay. I don't want to blast your guys' ears out or you guys can't hear me. All right, cool. Thank you, Alan. Okay, so I was also looking at something in Match, but I like the setup in Twilio, and I like Twilio in general better than Match. I'm really not familiar all that much with Match, so that would be a pure technical play. It's definitely valid, but I would hate to get, but that is triggering now. Whereas Twilio, we need to rally about $1.25 or so, which isn't much in a $124 stock. But anyhow, so what we're looking at. So this is the item. Let me pull in the day. I believe this is the day. Okay, so this is the daily chart. Let's get Twilio up here. Okay, so what we're seeing here, let me magnify this just a little bit. Okay, a little bit better look at this. Right. Drawing tool. Okay. So what we are looking at here, and this is, remember the inside bar is just what it sounds like. This bar here is inside of the previous bar. It's a consolidation type of trade. And when it breaks out of that consolidation formation, it can usually lead to, I don't want to say explosive moves, but definitely it can move from there. So when you have an inside bar, it is valid for 2 days. So it didn't do anything yesterday, but it's still valid today. So bar 1, bar 2, and then either one of these could be bar 3 for our trigger. So how do you know where this is going to trigger? It's not 125.57, it's 125.15 if I remember correctly. Yeah, I have the wrong mark set here, at least here. I thought I changed it. 125.15, that is our trigger price. The high today was 24.93, so we're not far. We have a market that is still marginally lower on the day. I would imagine that if we have a friendly market in the afternoon, we may get something here. But when these moves happen, they tend to happen quickly. So waiting for it to trigger, then figuring out what we want to do with an option doesn't make a whole lot of sense. Everybody follow me so far? What I like about this, A, I like the company. B, we're getting in at value. We have an upward trending Dacian channel. We've seen it basically find support 3 days in a row at this. This thick blue line is the 50-day moving average, and we have the trigger. So now we have to figure out, okay, one, if this triggers, we have to base it on the price that it triggers at, not where it's trading now. So that's why I'm saying we're going to have to do a little bit of interpolation. It's not an exact science, right? Because things can change. Gamma can change, theta can come out, implied volatility could go up or down. Is the projection kind of messed up? Looking a little bit janky over by me. I'm just gonna reload this. You'll lose video for a second. You won't lose me audio wise. Okay, that should be better. And you guys should see Twilio up there, which you do. I think we're good. Okay, so what we need to do is figure out what the projected move is if we get this trigger at 125.15. Well, how do we do that? We're going to need our trading tool. Well, like it wants to move. Come on. This is the easy part. Restore. There. Okay. So we're still going to use, since we don't have any hard information of where implied volatility is going to be, if we do rally that dollar and 25 cents, whatever it is, we're going to have to go with what we think implied, well, or what we know implied volatility is now. Now, if I thought implied volatility was going to be a lot different if we rally a dollar, I could argue it might be a little bit lower. But, you know, you're kind of, you're pushing it here. And we probably want to give ourselves some time, just given how we've seen these type of trades work. They're working slowly. This is not a gap up type of market that we're in. It is a grind. Charlie and I were talking about that yesterday. Okay, so 125.15, and not where we're trading now, is going to be what we want to base that move on. Won't be a huge difference, but it's a difference, right? It's a, you know, it's a buck, buck and a quarter, $1.50, whatever it is. So let's look at regular May. Regular May will be May 17th. Now, one thing that we're going to have to keep in mind is look where this is. Earnings. Earnings are on the 14th. I don't want to pay for implied vol that I don't have to. So let's just go out to May 3rd. Go to May 3rd. And the implied volatility for May 3rd, as we can see, I'm paying basically 20 vols less. Why? Because, well, the market seems to think that it's going to be sometime between May 3rd and May 10th, because if you see, May 10th vol is way up there too. This is saying that the estimate is May 14th, so that may change. What the market does know is that it's after May 3rd, or at least that's what it's pricing in, and we have no information that would make us think otherwise. All right, so that vol is 48.9. So 48.9 vol is targeting an area basically in the 140 area. Some in the 59% confidence interval is 139. The full standard deviation is just shy of 141. We're probably going to have, if we're lucky, we're going to have single strikes. If not, we're maybe even wider than that. I've not looked. We're going to need some more strikes. We're going to need a bigger boat. May 3rd. We do have single strikes, so I think targeting the 140 area isn't crazy. Now, what does that look like on the chart? These highs are at 136, so we are going to have to make new highs. Now, that doesn't mean that we're going to have to make new highs to max the spread out, not to necessarily be profitable. So I'm still okay. And since we have single strikes, let's target the 139 and see what that looks like. If that's an okay reward to risk, well, let's look at that. So let's look at the 137, 139 call spread. That is trading. That is trading, well, it's a wide market. The market is showing a credit bid, which we know is BS. Excuse my language. Because nobody gets paid a credit to put on a debit call spread, right? So, but we do know that it's offered at 73. So I'm thinking that this thing is probably somewhere in the neighborhood of trading 50 cents. Probably in the neighborhood of trading 50 cents. Because I'm saying it's probably 25 bid at 73, which, you know, basically puts 50 in the middle. If we do get 50 cents to buy this, well, we know that that's going to be great reward to risk. 137, 139. It's going to max itself out at 139 or higher. We're paying 50 cents to get in this. We're getting 3 to 1, right? We can make $2 on our spread. We have to pay 50 cents to watch this movie play itself out. Net between that, we can make $1.50. Reward to risk, 50 divided by, 150 divided by 50, 3. So that's 3 to 1. What do we give up if we go down a strike from there? Not saying that we necessarily want to, but let's see. So the 36.38, that's trading probably in that same range, 30 to 80 cents. So that's like 55 cents. So we're paying a nickel more to have our spread kick in $1 sooner. Well, instead of getting 3 to 1, we're getting 2.64 to 1. I'm okay with that. I actually like this a little bit better. It's not worth saving a nickel to have a full dollar be in our bag. Now, realizing the other thing that we have to realize, now that's if we're trading right here. Remember, we're trading, what is it, $1.60 below where this is going to trigger. So we have to figure out using delta where this should trade if we're trading $1.50 higher, $1.60 higher, whatever that is. So if we're trading $1.60 higher and the delta is 4 on this, and remember we do have a little bit of gamma. So let's say between now another 25 up there, or another $1.25, $1.40, we're probably going to be looking at a delta closer to 7 than 4. So this is actually going to be trading. It'll be trading if let's make it nice and easy. 8 delta. So that means it's going to be 8 cents plus another half of that. It's going to be 12 cents higher. So now we're going to be paying, let's just say, if we're lucky, we pay 65 cents. Well, now we're getting into that area where now it's just 2 to 1. So now we want to go back and look at that 37.39, and that is going to have less than that delta. Probably have to pay 60 cents for that. That's 2.33 to 1. I think that's probably the play. So if we get the trigger, and we want to be ready, right? We want to go with the Twilo. 5.8. 137, 139 call spread, and try and buy that for 60 cents. I know it's going to trigger? No, I don't. But if it does, we want to be ready. Okay, any questions on that? I am recording this, so if you want to review it, by all means. If you're not here, well, then I'm talking to somebody who's not here, but that's why it's recorded. All right, if there are no recordings, let me get this.
Okay, guys. As I said, I'd be...
Sorry. Monitoring both rooms. Scott got on the mic. All right, so if there's no questions, let's get the recorder turned off. Let me get this video rendered out to you, and we'll just go from there.